Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the delayed, the not postponed, the postponed TGI Friday. Thank God it's Friday, 18th of March, Bull versus Bear webinar with Steve Miley on the call for trade day. So welcome everyone. We've been, apologies first of all, we've had some technical issues with the software streaming software, Vimeo, which meant that James wasn't able to get onto the webinar. He was covering me yesterday, so he wasn't able to get onto the webinar yesterday. So deepest apologies for that. But we think we're not 100%. We do feel that we've kind of sorted the bug. It's often when we transfer the transfer between myself and James that we get this bug, and we thought we'd had it fixed, and we didn't get it fixed. Anyway, enough of my excuses. But so apologies first of all for the lack of webinar yesterday. The other thing is today's webinar is obviously actually 30 minutes later. For personal circumstances, I couldn't get on to the at the normal time. And if you're in UK, Europe, obviously we're actually starting an hour earlier this week. We have been, and only starting half an hour earlier today than we normally do, because we're still on the daylight saving time has changed in the US and it hasn't changed in UK, Europe yet. We've got another week of this, so only 4 hours between GMT and Eastern time at the moment. And then that will continue next week. So if you are in the UK or Europe, we're going to be starting the webinars at 11:30 GMT. So Eastern time, Central time, Central European time. That is, it's going to be at 12:30. And if you're in the US, your times haven't changed apart from today. Right, enough of that. I hope that's clear. But again, apologies for tomorrow. So let's crack on for what we've got in here today. We're looking at the calendar now. It's a relatively light calendar. Unless you're trading the Canadian dollar in 26 minutes time. We have retail sales out of Canada. So if you're trading the Canadian dollar on the futures, which you can do, just so you guys are aware, if you want to trade futures, FX futures, you can. So we've got the Canadian retail sales data coming in 25 minutes time now. Existing home sales from the US is not a big deal. And we do have FOMC member Bowman speaking later today, 1500. That is Eastern time, US Eastern time, but probably not expecting too much out of that, seeing as we've just had the Fed this week. Talking of the Fed, I'll just touch on a little few of the things that James was going to talk about. So even though the Fed pretty much nailed on delivered what the market has been expecting. So the market expected a 25 basis point rate hike. That's what we got. They've basically indicated there's going to be a rate hike of each of the rest of the meetings for the balance of this year, is their indication, which the market is pretty much priced in already. If anything, there was probably, I think the market expectation and by the market reaction was that the Fed could have been more hawkish, so more aggressive with their potential interest rate hikes than we'd expected. And if anything, they weren't any less hawkish, they weren't any more dovish. But I think because they weren't more hawkish, the market almost had a little bit of a sigh of relief. But also, now this sounds a little bit counterintuitive, but the equity markets now want the Fed. Rate hikes are generally not good for equities, right? Because it increases the cost of borrowing. It can, for both the corporates themselves, but also for the consumer. And then that obviously takes money out of the system and capital out of the system and flow out the money flow out the system. And then that means there needs potential less demand, right? It's choking off demand. That's what raising interest rates is there to do. However, and I think the market is and the stock indices and the stock markets are very aware that inflation is a real problem that needs to be got under control. And if the Fed are kind of too soft, they're too dovish, then high inflation is not good for the economy in the long run, and it's not good for the corporates in the long run. So I think they're okay with the Fed staying on the course that's been priced in, and hence equity markets that were very choppy, as you guys will well know if you were trading those equity indices through the Fed meeting, spiked lower, and then a really strong rebound. But you have to remember that the equity markets are already significantly higher ahead of the Fed on a Wednesday due to ongoing positivity coming through from one, China having had that massive sell-off, the rebound that, we had the sell-off Monday through Tuesday, and then we got the rebound on Wednesday through Thursday. So we had that going on, and then we've also seen, nothing really concrete on the Ukrainian situation and the talks between Ukraine and Russia. But what we've certainly seen is there are glimmers of hope. Okay, and there are glimmers of, just reading between the lines and, listening to political commentators. They're saying that, there is sort of slow progress being made. Russia seems willing to make some concessions, and they're laying out, yesterday Putin had a call with the Erdogan, the president of Turkey, outlining what he requires. Already Ukraine have said they won't look to join NATO. So we are seeing some slight progress. And although, the war is a horrible thing, the conflict is a horrible thing, and, we're getting, continued, terror reports of civilian casualties. What we are also seeing is no massive escalation. And you've also not really seeing any, the Ukrainians are standing firm, and a lot of the major cities are still being held. So, that leads to a potential then for more negotiation, if it's not going Russia's way, for Russia to look for a get out of this. And if that happens, then obviously it's going to be back to kind of a more of a risk-on environment, and that's going to boost equity. So both the China situation and the less negative, so de facto more positive tone coming out of Russia-Ukraine talks and the actual conflict itself has meant that stocks have been on a wild ride higher for the last few days, and they were already higher pre-Fed on Wednesday, and then went even higher, obviously post-Fed, even though in between, as the announcement came, they did chop initially back lower and then chop back higher again. And then we got a follow through again yesterday. The market was kind of fairly stable for the early session and then had a strong close. And then overnight, we're actually a little bit lower. So we've already looked at the calendar in here. Let's take a little look at the 5 things to start your day in here. So the US warned that Russian President Vladimir Putin is likely to brandish threats to nuclear weapons. That's the US talking. That's not Russia talking, okay? And then also there's a call between Biden and Xi Jinping of China if Beijing backs Russia. So bringing China maybe a little bit in. Nickel dropped and the limit down again, having had that massive squeeze higher 2 weeks ago and has been closed on the LME, the London Metals Exchange. Today's triple witching. So you get the triple witching, so the third Friday of every March, June, September, December. So for those of you who don't know much about futures, three key events. So these are the expiries of the contracts, of the futures contracts in March, June, September, and December on the equity indices. So you have not only the equity indices, but you have the expiration of single stock options. You get the futures on the stock indices. That's what we're trading. If you're trading the S&P or you're trading the Nasdaq, you're trading the future on the stock index. There's also single stock options. So that's options on individual stocks, say Amazon. And then the options on the stock indices. So this is the options on the stock indices as well. So all three of those expire on the March contract today. You should all be trading on the June contracts, by the way. So they all expire on the March contracts today, and it's called triple witching. Okay. Now, sometimes that can have a significant effect on markets from technical reasons. Okay. However, not always. Okay. So Goldman Sachs estimates that roughly $3.5 trillion of single stock and index level options are set to expire. So it can have an impact on markets, but not always. Okay, so and there's not much we can do about it apart from just go with the ride. Okay, so and then they're just saying fading gains. So stocks had good gains. They're back. Stock futures are pointing lower today. European equity indices have dipped back lower. What else do I have for you in here? So US futures dipped with stocks as oil extends rally. So a little bit of concerns. Inflationary pressures coming back from oil. Oil's pushing back higher. Gold is nudging back higher as well. And so those are concerns in here. Treasuries and dollar rises, growth outlook clouded by war. So concerns. Treasuries back higher again. So treasuries going higher prices, lower yields, but not really helping exit. The reason they're going up and the reason the dollar's going up is a risk-off event. Okay, so but I think this is a little bit journalist fitting a story to the price action. Okay, but oil pushing back higher is a little bit of a concern. Obviously, oil's had a significant setback from its highs. It went up to $130. Came back sub $100, and now nudging back higher above $100 in here. So some concerns that inflationary pressures from oil could then to reignite, and we could see oil back up at the highs, and that will be a negative for stocks certainly and for the global economy. And then again, look, they're talking about the triple witching event in here. If we take a look at, say, I said there, European indices, but they're not massively down considering how much we're up. Remember, these indices have been up like 3-4, between 3 and 4% for the last few days in here. Okay, Monday, Tuesday, Wednesday up 3-4% on the major European equities indices. We're up like 8-9-10% depending on which index you looked at. So the fact that they've dipped lower by 1% this morning is not a massive big deal. Okay, it's not really that damaging. Just maybe a correction going into the end of the week. And if we look in here, yesterday, it's only got the Dow showing here, but Dow was up 1%. S&P was up about the same. Nasdaq was nearly up 2% in here. And then this morning on the futures, we're slightly lower, but not massive, right? 0.5% down on Dow, 0.6 on S&P, 0.74. So just dipping slightly back lower. And we'll take a look at the charts shortly to delve a little bit more into that. So this is bid. If you should, I certainly recommend. I've said to you guys before, sign up for this. Remember, you can sign up for this 5 things you need to start your day, guys. If you go to the Bloomberg homepage, all right. So this is published every day. If you go to and it comes out actually 3 times a day, I think. And there's an Asian version, a European version, and let me see in here. So if you go over, where is it? Over here. Oh, no, it's not on here. Let me see. I think it's on the markets page. Bloomberg Markets. Let me go there. Yeah, over here on the right-hand side. So if you go to bloomberg.com/markets, over on the right-hand side, the most important market news of the day, get our market daily news there. You sign up, stick your email in there, and you get a daily sign-up. Because remember, all these articles you see, I'm going through these articles, looking at them. I've got a subscription. Subscription is not cheap for Bloomberg. They used to be free up to about 2-3 years ago. Now you have to pay for it. I would just recommend using Reuters, but I do have at the moment, they're doing a cheap subscription, so I'm on a cheap subscription, but I'll probably end up cancelling that because you can get all the information elsewhere. So you can come to Reuters and you get the same kind of news. So morning bid is their kind of equivalent of 5 things need to start today. So obviously Fed increased hike rates as we expected in here, and then just some concerns about yield curve inversion. Okay, so the 2-10s curve is just there's been just 24 pips, 24 basis points, 4% between them. It's not far from an inverting. Now, when the curve inverts, not always, but sometimes and often, most of the time, is a good lead indicator of a recession following in the next 1 to 2 years. Now, not always. Yeah. So in here you can see it inverted here. A couple of years later, then we had recession. Inverted here a couple of years later. So this is around the 2000s. Recession, this is the global financial crisis, and then recession and through that. We did actually invert here. It's not showing the inverted. It did actually invert. I think through COVID. But we haven't had a recession, post COVID, but we're still within just about the 2 years, right? So, but look, and then we've obviously steepened. So it did actually invert here. It's not quite showing that as inverted, but I'm sure it did invert as we went into COVID. But it might have been actually pre-COVID, and then the market now getting very close to inverting again. So that's often a signal of a potential recession going forward. Oil up and back above $100. They're talking about that as well in here. And then there was a lot of concerns as well about a Russian default, whether it actually impacted the market on their debt, bond default. So at the moment they haven't. The creditors have received payment in dollars. There was talk they were going to pay in rubles, but at the moment a debt default seems to have been avoided. And then war, inflation, and oil cap stock rebounds as yields warn. Okay, so again here, focusing on the fact that even though we've got a lot of positivity back in the market in the last few days, we've still got the war and the inflation spectre hanging over, and these higher oil price hanging over markets in here. What else do we have in here? No, I wasn't going to show you anything from there. Let's take a look at the dot plot chart. Now we're looking out to May. Now May is actually pricing in nailed on. So, at the moment, we're obviously the current rate, with the hike that we had on Wednesday, we're at between the current target rate is 25 to 50. It's now pretty nailed on now. What it is nailed on, because they're saying this is pricing in now for the next meeting in May, 70% chance of a move up to 50 to 75. So that'll be a 25 basis point hike, and actually a 30% chance of our full half point, okay, higher. Okay, so it's basically saying there's a 100% chance we're going to get a hike of at least 25, and there's a 30% chance it will be higher, is what the market's starting to price in. So this is more aggressive than the Fed. You know, the Fed have kind of signaled that they're going up by 25 at each of the next meetings that we have throughout the year. So we have 1, 2, 3, 4, 5, 6, 6 meetings through the year. So the Fed have basically signaled 6 rate hikes of 25 for the rest of the year. The market's trying to pricing something a little bit more. Again, pricing is something more aggressive than that. Okay. Oh, it's logged me out. Let me log back in here. And we'll take a look at some charts. So I'm going to kick off with the S&P on the daily. So here's the surging rally. Remember, I pointed this one out, this bullish outside pattern in here back on Tuesday. Put that on the site, on the members part, on the members site in here, back in here before that was completed, signaling this was a really important positive reversal day. Was setting up before it actually completed. Then we completed it by pushing above Monday's high, and then that surging rally Tuesday, choppy on Wednesday, down, you know, through the Fed and back higher, and then but a strong close in here. And look, you're just below this really important high in here. Remember, this is on the June contract, guys. Yeah. So up in here, we've got this peak at 43.65.75. Yesterday we got up to 43.61. If we get above there, you've got basically a triple bottom down here. A triple bottom, 1, 2, 3 lows. The lows from 24th of Feb, the low from the 8th of March, and the low this week from the 15th of March. You get a triple bottom above there. If we get above there, it's a really bullish statement for this to be a bigger, better basing pattern, pointing the market higher. Pretty much there, you know, you could say at least into next week. Okay, the market's dipped lower. Let's just step into a 30-minute chart now. And you can see higher highs and higher lows. There's the Fed. There's the price action through the Fed. So the market had that spike lower initially on the Fed, but it quickly came back and then ended up on the day. So, and it was already significantly higher. It already rallied from here through the day. So it was already significantly higher into the Fed, spiked lower through the Fed, and then ended up higher, and then higher again, swung back, and then higher again yesterday. And then you can see dipping, but you do have a lower low in here. That's a little bit of a concern. So you've got lower low, lower high, lower high, and then a new lower low. So we've got to step in and see where we're looking for the support in here. And I think what's important in here, you see this low here. So this is then the some of the impulsive moves that we had yesterday, and this was like really it's the last swing low, right? You could argue that's the last swing low, but this is, you know, a significant last swing low in here. You've got these two lows here from the last leg of the up move yesterday, and that low there is at 43.64.5, and you can see the low today so far 43.64.5. We've held it exactly. Okay, so it's really important that we've held that, and now you can see we're trending back higher. I think, you know, guys, I'm, you know, looking at a lot of this from the bullish side. You know, I don't think you can help look at it from the bullish side, given the price action we've had in the last 3 days, right? You're in a strong uptrend. Yes, we've got this lower low and lower high now, but I think what you need to keep an eye on, I've been keeping my eye on now, are these two counter trend lines. Now, the bigger one, if you're trading, maybe like position trading on the day trade, and you're going to take like a position, is this bigger one that comes from the top and then from this kind of overnight high. Okay, now that's some ways away. That's all the way up at 43.86. Okay, however, you got the more accelerated line, comes down just from the kind of overnight activity either through there, or you've got the other one then, you know, I'd argue through here, which we're kind of flirting with now. That's probably the better line, yeah, because you got the touch on there, and this is on the 30-minute charts. If we can get above, you know, minimally above the bar, the 30-minute bar, the last bar we had in here, not the current bar, the last bar we had in here, which is at 43.76, that would be my initial bullish signal, and then you got the trend line that's more like 43.8, about 79.5. You can get through there, 43.76, 43.80 kind of area. This all looks a lot more positive again. Yeah, this is what, for me, I mean, this is how I would approach the market. I say, well, where's the main trend? Well, the main trend's up. I want to be playing it from the long side. Okay, but what's going on right now? Well, we're getting a correction of the main trend, and you do have lower lows and lower highs. So that's a little bit of a worry, but we've held support. We identified this support, 43.64.5, and we're holding that support. Now, if it breaks 43.64.5 for a quick day trade, I'm happy to be short and looking for a break down into this area here. However, if it breaks above this kind of area here, we've had the correction. I'm looking for the next swing up. Not only a swing back up to yesterday's high, but then potentially, as we said earlier, if I go back to the daily chart, you've got that peak there, right? 43.65.75. And then if we get above there, then you're going to get an even bigger acceleration on the upside, likely. It's going to run stops up through there. You've got the triple bottom pattern. So, I'd be playing this looking for the swing. If you want to be aggressive, you wait for a break above 43.76, a little bit more cautious, 43.80, a lot more cautious all the way up here. You're waiting for it to get back above 43.94 and a quarter, the overnight high. So there's some trigger points on the upside. Breaks below this low, the current low, which is also that low from yesterday, remember, down at 43.64.5, then that opens up a short, maybe moving down towards like 43.35, 43.30 area, down to here. Okay, so kind of a little bit binary, but I'm like 65.35, want to buy this, but happy to go short on the break through the support levels. It's going to be a similar outlook for the Nasdaq. Really strong recovery effort in here. Only a modest dip, we've had overnight. If we step in on the Nasdaq, and you're still some way there from making that high, that's the high you need. And then again, you've got kind of a triple bottom. That's all the way up at 14.389, so some way away from that. But it could get there today, could get there today, but some way from making the bigger bullish statement. But you've still reversed these trend lines. Okay, so looking bullish. Obviously, we've had the swing back lower. Looking at the swing lower, here's the swing. Same kind of pattern in here. Lower, lower, lower. Actually, it's not made a lower high, so actually more positive. Okay, you've made a lower high, not a lower low. Lower low, lower high. Hasn't made a lower low. It's holding at this lows. Now, I think the equivalent level here is in here, this low here, and it's held above there. Is that low there? So the equivalent level, remember, we looked at that 64.5 level that it held. We didn't even get down there. That's the equivalent level there. On the Nasdaq, that would be 13.942.5. It's held above there. The low overnight was 13.966.5. So it's held that same support on the S&P that held exactly. It's held above that. And look, on this next swing, it's holding above it. Now, again, in here, what I do is zoom in a little bit. You could even go into a shorter term chart in here, but you can do it on this chart. Now, there's the bigger down line in there. It's a good line, right? You'd argue 2, 3, 4 touches on that line. Above not this current bar, the last bar's high, it would also take us through the trend line. So the last bar's high was, and this is on a 30-minute chart, 14.01575. 14.01575. Above there, that starts to look bullish. It's breaking the trend line in here as well. Certainly above these we've got double peaks up here on the candles. They are at 14.040.75, 14.040.50. Yeah, so back above 14.40.41 area would look kind of be a confirmation. But I'd be almost happy to go, get long on this above 14,015.75 up through there. Now, you'd either stop yourself out below the low, and then you're looking for a move all the way back up to yesterday's high, and then above, and then potentially, going back to the daily, go and challenge that triple bottom high. That triple bottom high, as we said, is up at 14.389. Going back to the intraday in here, easily going back up to the high and then potentially above, so there's plenty in this. So a stop even below here, but you could even have to stop below yesterday's low, which is down at 13.966.5, or you got the stop here. So it's up to you where to put the stop. Trading the micros, you're looking for bigger moves. Remember, we've got the volatility there. This thing's moving. This thing isn't moving, 0.5%, 0.75%. This is moving to 1.5%, 2.5% a day, right? So you've got plenty of big moves in there. So trade smaller size. Okay. Let me switch to look at some of the commodity markets. Quick nod to oil and gold. We'll kick off with gold. So gold is trying to recover. So had a decent recovery yesterday. Dipped and rebounding here today. Let's step in then but still got the big sell-off in here over the last week and a half. If we step into the 30 minutes, what's it looking like? Well, said yesterday there's maybe a buy opportunity on gold. We looked at these downtrend lines. Let me get rid of all this old analysis in here. So in here, you'd argue there's a little basing pattern been put in, but then the market has dipped back lower in here. And it seems to me now we can actually have gold and stocks going higher at the same time. Almost to the extent we can have oil and gold going. We had that inverse relationship between basically both gold and oil were inversely related to the stock indices, through the outbreak of the war. Okay, now we're seeing they're kind of going back a little bit, maybe in line with each other. So gold's rallied in here over the last day and a half or so, and obviously stocks are back higher in here. And you see gold dip just below this little swing low in here. You could argue like a little topping pattern. I'm going to just zoom in a little bit on this more. So you could argue this is a head and shoulders top sort of thing in here. Head up here, shoulder. You could argue you kind of got either a neckline across there that's been broken, or you've got an upward facing neckline through, where are we? Through here. Okay, it's been broken. Wherever you argue the neckline is, you could even argue the neckline's kind of bang where we are right now, but you'd still argue that, as you put it through here, I got a wrong line there. Put the line through here, you still argue it's been flirted with and broken. So, but you could argue then equally that that the support's kind of being defended, this area here, and we're pointing back higher. I mean, jury's out on that one. I've not got a strong opinion. I'd be inclined to say this is a topping pattern that's failed. The market's tried to signal the top, hasn't gone lower, and now if you look at where the counter trend line is from the top, we're way through that, right? Through here. And it's a good trend line. Look, touch, you draw it off these two, get third touch there, and then boom, up through it. Yeah. And you spike lower, you kind of head fake down lower, suck some bad shorts in who think this is a head and shoulders top, and then reject it, boom, to the upside. So I'd probably play this from the long side, and I think you can have, both those views now, the equity market bull view and the gold bull view. Let's take a look at oil. So oil had a really good day back at higher yesterday. However, fat is failing back. Already this candlestick, at the moment, this is like a shooting star. So it's a negative candlestick. But obviously it's very early on in the day. We've got the whole US session. But if you look in here, so there's a really strong day. You'd argue, right? Let me get rid of, again, all this old analysis. And if I go in, on the uptrend line, you draw it up through like here, you've reversed it. No matter where you look at that trend line, it's definitely reversed. You look at I've got the 13 period exponential moving average here. You can see it's been really good as support. It was yesterday. On the rally, reversed down through there, and now it's acting as resistance. I think oil's pointing lower, and that's going to help stocks to the upside if oil can retrace. Not massively bearish, but it could easily retrace down here towards like the 97, 96 kind of area. Got a lot of value down here. Look at this big value area, a lot of congestion here, a lot of stuff went on down here. Not too much in here. It's probably got some work to do in this area here between 99 and like 102. Probably wants to do some work in there. So I wouldn't be surprised to see this push down towards 99, maybe bounce back up and fill in some volume around between 99 and 102. So watching out for that today. Downside pressures on oil, probably pointing to a more positive tone as well for the stocks, which we've already talked about. Right. I think that's all I've got for you guys. I'm going to wish you all a great trading day. Stay safe. I'll be back with you on Monday. Have a great weekend too. Until then, take care.